Okay, let's dive right into this. Welcome to the Explainer. Today, we're going to unpack something you literally use every single day, probably without giving it a second thought. Money. But here's the secret. Money isn't just paper or metal or some glowing number on your phone screen. It's actually a constantly evolving technology. And the crazy part? It's built entirely on one totally invisible, super fragile thing: human trust. So buckle up, because we're going back to the very beginning to trace the incredible, wild journey of currency through thousands of years of economic history.
Now, I want you to imagine something for a second. Imagine waking up tomorrow and you discover that money just no longer exists. No cash in your wallet, no bank transfers, no debit cards, no Apple Pay, nothing. If you needed to buy food for your family, how exactly would you do it? How's your boss going to pay you? Heck, how would society even function? Well, the short answer is it would struggle fast. Everything would literally grind to a halt. You see, money is absolutely one of humanity's greatest inventions purely because it makes trade effortless. But, it didn't always exist.
So here's our roadmap for the journey today. We're stepping through time starting at 10,000 BCE with barter, hitting commodities, coins, paper, the digital boom of the 90s, all the way to the 2009 crypto era. And as we zip through this, I want you to keep a specific pattern in mind. It's kind of the stealth agenda for this whole explainer. Every single era of money was invented for one specific reason. It was created to solve the fatal flaw of the system that came right before it.
All right, let's start at the beginning. For thousands of years, the biggest friction point of trade was this tricky little trap that economists call the double coincidence of wants. Sounds super academic, right? But it really just boils down to this. For a trade to happen without money, you got to have exactly what the other person wants, and, here's the kicker, they must have exactly what you want at the exact same time.
Let's put that into perspective. Say you're a fisherman, right? And you really want some maize. So you take your fresh catch over to the farmer. But the farmer's like, I already have enough fish. What I actually need is a goat. Well, you don't have a goat. So what happens? The trade just completely fails. Even though you both have perfectly valuable goods, you're just stuck. This agonizing friction meant early trade was incredibly slow. It basically proved that pure barter simply couldn't support growing, specializing economies. Humanity desperately needed a universal medium of exchange, a real game changer.
To fix this massive headache, we shifted to commodity money. We're talking things like salt or cowrie shells, which became incredibly popular across African and Asian markets. But wait, you can't just use anything as currency, right? To actually work, it needs a few specific traits. It has to be durable, so it doesn't just rot away. It needs to be portable, so you can carry it around. Divisible, for those smaller everyday purchases. Scarce, so it actually holds value. And most importantly, universally accepted. Take salt, for example. People used it because, well, everyone absolutely needed it to preserve food before refrigerators were a thing. It had undeniable built-in value.
But, and there's always a but, organic commodities had their own fatal flaws. Sure, a cow is super valuable, but a cow can get sick and, die. Grain can rot sitting in a storehouse. Plus, think about it. How on earth do you pay for a small basket of vegetables with a live cow? You can't exactly chop it in half without ruining the whole shebang. This severe physical limitation really pushed humanity away from using livestock in agriculture and steered us toward the rock-solid reliability of precious metals, gold and silver. They don't rust, they're super rare, and just a tiny little piece can hold massive value.
And that realization led to a massive, massive upgrade right around 600 BCE, the invention of metal coins. Before coins, merchants literally had to sit there and weigh out chunks of silver for every single trade just to make sure they weren't getting scammed. Coins completely changed the game. They offered a standardized weight, a fixed shape, and crucially, an official ruler's stamp of guarantee. For the very first time, money wasn't just a shiny object anymore. It was a symbol of authority backed by early governments. The Roman Empire actually used this exact concept to pay their soldiers and basically build a global economy. But true to our recurring motif today, there was another problem. As global trade kept expanding, carrying large chests of heavy metal across entire continents became a total logistical nightmare. I mean, it was incredibly heavy, it was painfully slow, and let's be real, a giant caravan full of gold was basically a glowing neon target for thieves and bandits. Merchants traveling these crazy long distances desperately needed a safer, lighter way to transport their wealth. So, what was the solution? It was actually highly intuitive, and it gave birth to paper money and the very first banking systems. Think of it like this. Step 1. A wealthy merchant deposits their heavy, physical gold in a secure vault. Step 2. The bank issues a piece of paper, just a receipt, proving that the gold is safely stored away. Now the revolutionary part is step 3. The merchant realizes, hey,
I don't need to actually go get the gold back to buy stuff. They just hand the paper receipt directly to the seller. Just like that, the crushing physical weight of metal was efficiently replaced by paper trust. Now, for a long time, paper money was directly tied to real gold sitting in a vault somewhere, a system you probably heard of called the gold standard. Now, this offered really high stability because governments couldn't just print endless piles of paper. They literally needed the physical gold to back it up. But the downside? It completely lacked flexibility. During the global wars or the severe economic crashes we saw in the 20th century, governments realized they desperately needed the flexibility to create more money to stimulate the economy. So to gain that control, they ultimately abandoned the gold standard entirely, and that shifted us into the era of fiat money. And that brings us to exactly what's sitting in your pocket right now: modern fiat money. Whether we're talking about the US dollar, the Nigerian naira, or the Ghanaian cedi, the actual piece of paper itself has zero intrinsic value. It's not backed by gold, it's not backed by silver. It works simply because the government declares it legal tender and the public completely trusts it. It all comes right back to that core motif: human trust. If people were to suddenly stop believing in the currency, it would literally lose its value overnight. Okay, now the pace really accelerates because the late 20th century flipped the script on us yet again. Enter the digital era. With the explosive rise of computers, credit cards, ATMs, and the internet, money made its most dramatic physical transformation yet. It became completely invisible. Seriously, just a string of ones and zeros sitting on a bank server somewhere. But here's the fascinating part. By becoming invisible, it became exponentially more powerful. It could suddenly move across the entire globe at the literal speed of light. And nowhere is the sheer power of digital money more evident than in the mobile money revolution. This tech was amazing because it bypassed traditional brick-and-mortar banks entirely. You don't need a fancy formal bank account, just a basic, everyday mobile phone. This brought millions of previously unbanked people directly into the financial system for the first time. It empowers a market trader in Lagos to accept digital payments safely, or a business owner in Nairobi to pay their suppliers instantly without carrying wads of dangerous cash. It was, without a doubt, a true leapfrog moment in global financial inclusion. But even with the magic of mobile money, there was still a middleman involved. There was always a bank, a telecom company, or some central server processing the transaction behind the scenes. Then came the 2008 global financial crisis, and man, that severely damaged public trust in large financial institutions. It sparked this massive, highly disruptive question: do we really need banks to move money? Like, do we actually have to trust a central authority with our hard-earned wealth? Well, the answer to that arrived right around the same time in 2008 with a completely groundbreaking underlying technology: the blockchain. So what is it? It's essentially a transparent, highly secure digital record system that verifies transactions without any central authority at all. Instead of trusting a single centralized bank to update your balance, you're trusting a massive decentralized network of thousands of computers all over the world. It completely replaced centralized institutional trust with decentralized trust in cryptography. And this, as you probably guessed, birthed Bitcoin. But the true core disruption of Bitcoin really lies in one very specific, hard-coded number: 21 million. That is the absolute maximum number of Bitcoins that will ever exist. Now, why does this matter? Well, think back to what we just talked about with fiat currency. Governments can and absolutely do print endless amounts of fiat money, which can lead to inflation and a rapid loss of your purchasing power. Bitcoin introduced absolute digital scarcity. It provides this really powerful contrast to unlimited printing, which makes it hugely appealing to people looking for a modern-day digital equivalent to gold. And this shift, it created a whole new paradigm, moving us away from traditional banking and straight into decentralized finance, or DeFi. Traditional banking is highly centralized, right? You're completely dependent on their business hours, their fees, and ultimately, their permission. Decentralized finance completely flips this, offering individual global control. It is entirely trustless. What that means in reality is a crypto investor sitting in Abuja can send thousands of dollars to a partner in Europe at 2 a.m. on a Sunday, instantly, for a fraction of the cost, without ever having to ask a bank for permission. Mind-blowing. So, what comes next? As we look forward, the future of money isn't just going to be one single monolithic thing. It's an entire ecosystem. I mean, governments aren't just sitting still. They're actively developing central bank digital currencies, or CBDCs, to compete directly with crypto. Artificial intelligence is already out there handling global fraud detection and running automated trading. Plus, we're rapidly accelerating toward totally cashless societies. Government digital currencies, AI platforms, and decentralized crypto are all going to coexist in this highly complex, super fast-moving financial landscape.
So, looking back at this incredible timeline, the pattern is just undeniable. From struggling to trade a fish for a goat in 10,000 BCE, to trading commodity shells, to metal coins stamped by ancient kings, to paper receipts in old bank vaults, to invisible digital signals, and finally, to decentralized cryptographic code. Every single step we took proved our thesis. The medium of money always evolves to solve the flaws of the past system. At the end of the day, whether you're trading bags of salt, handing over a crumpled paper dollar, or transferring fractions of a Bitcoin, the physical or digital object isn't what truly matters. Money only works because people trust it. The technology, it'll keep evolving for sure, but human trust remains and always will be the true currency of the world. Which leaves us with one final, pretty massive question as we look to the future. As algorithms and code start replacing banks and governments, who or what will you choose to trust with your money tomorrow? Thanks for tuning in, and I'll see you on the next explainer.